Hi, welcome back to the channel. Today I'd like to discuss the three great financial risks when it comes to retirement, specifically early retirement. The first of which is longevity risk. It's simply that you outlive your money. The second is inflation risk, and that's where the rate of inflation outpaces the returns on your portfolio and your purchasing power erodes over time. And the third, and I think the one that drives the most sleepless nights, especially for early retirees, is a sequence of returns risks. And that's where bad returns in the market early in your retirement simply can't be overcome by better returns later in your retirement. Meaning you're taking out money when the market is going down. To deal with this, Harold Levinsky originally came up with the bucket strategy, which separated your spending money from your investment money. He originally just had two buckets, cash and investments. Hi, my name's Kurt. I've been married for 33 and a half years and retired for 4.5. In those 4.5 years, my wife and I have learned a lot, and that's why I started this channel. If this kind of content sounds interesting to you, please feel free to like and subscribe and hit the notification bell so you'll be notified when I release future episodes. Also, please feel free to forward this on to family and friends that you feel like might also benefit from this kind of content. Over the last 100 years, the S&P 500 has seen greater than 20 bear markets, with a bear market being defined as a decline in value by more than 20%. When you look at those bear markets, they're really separated into two components. First of all is the fall, meaning going from the absolute peak prior to the bear market down to its lowest point, the trough. That lasts on average 9 to 12 months, with a median of 10 months. The second part of those bear markets is the recovery. That is, the time spent from the trough, or the bottom of that bear market, back to its original peak. This phase of a bear market can vary greatly, lasting from only a couple months, as was exampled in the COVID response in 2020, to more than 8 years in the Great Financial Recession, excluding the Great Depression, which took decades. So the total cycle of a bear market averages about 3 years, with a range of 2.5 to 8 years, again excluding the Great Depression. In order to deal with the emotional trauma that these bear markets can give a retired person, we've come up with the bucket system. I'd like to give a shout out to Fritz Gilbert at the Retirement Manifesto and Joe Kuhn at his self-titled YouTube channel for helping me understand the bucket system and understand how they put it into practice. In essence, the bucket strategy is really insurance against these bear markets. The most popular bucket strategy involves 3 buckets. Bucket 1 is really your spending money. This can vary from anywhere between 1 and 3 years worth of expenses and is typically kept in cash or cash-like assets, meaning CDs or money market accounts. The second bucket is what's been labeled the income bucket, and this is to get you beyond those first couple years, usually sized at about 3 to 7 years worth of expenses. These investments are safer, but not as safe as cash, usually bonds or blue chip dividend stocks. And finally, the third bucket is your growth bucket, your long-term bucket, something that's going to be beyond 5 to 7 years and is going to return well beyond the rate of inflation. The investments in this bucket are typically larger index funds. What are the advantages of the bucket system? Well, first of all, you get to isolate your near-term spending money from the volatility that the market presents. Secondly, it helps take the emotion out of your market selling, and it helps you sleep better. Third, it does still give you variability to deal with your risk tolerance in how big you size buckets numbers 1 and 2. And finally, it allows you to separate your portfolio size from a typical asset allocation, and it can avoid putting either too little or too much into safe assets, or vice versa, too little or too much into more aggressive assets. Now, what are the cons of the bucket system? First of all, it seems to increase the complexity of the day-to-day or year-to-year execution of your financial system. Secondly, it can result in a lower total portfolio return as the cash drag can be significant. And third, it's difficult or even impossible to use traditional modeling software to model the bucket system. Well, after the bear market of 2022, I elected to go to the bucket system, and it does allow me to sleep much better. In fact, I even have more total money in my growth bucket or aggressive stock allocation than I did before, where my true stock allocation now exceeds 70% of my total portfolio. Well, that's all I have for today. Thanks for tuning in, and remember, keep leveling up.